If you're investing in the financial market without knowing the current landscape and the outlook, you're basically on a battlefield without proper equipment and ammunition. It's just not a good idea. To help me better understand the financial market and prepare what's coming, I've researched over multiple market outlook published by the institutional investors, such as BlackRock, Merrill Lynch, who manages over billions and even trillions of dollars of financial assets. Based on my analysis, I've identified 3 core themes for the upcoming year: disruption, slowdown, and volatility. There are 2 major disruptions coming to the financial market. The first disruption is geopolitical tension. The 2 major powerhouses, the United States and China, are currently going through a trade war. And that tension has impacted the financial market in 2018 and expected to carry over to 2019. On the European side, there's a Brexit which is scheduled to be orchestrated in 2019, and there's uncertainty around whether or not it will be a hard Brexit. Additionally, the European Union and Italy is arguing over their spending and budget, and it's a typical scenario where parents are going through a divorce and kid is arguing for increased allowance for their spending. The second disruptive force is the tightening of fiscal policy. Since the crash of 2008, over $12 trillion of cash has been injected into the global economic system by the global central bank. And they shifted their gear to begin tightening those fiscal policy. For example, in the United States, they're increased the interest rate and they're unloading the balance sheet. In the European side, the European Central Bank, the ECB, has announced that they completed the quantitative easing program and began to look for opportunity to start tightening their policy. The 2 disruptions, the geopolitical tension and the tightening of the fiscal policy, has put a pressure on the global economy. Which brings us to the next theme, the slowdown of the global expansion. The geopolitical tension has expanded its impact in global trade. The uncertainty around trade regulation and potential increase in tariff has caused a slowdown in trade growth. And this is not a good news for the corporate earning potentials. In the United States, the corporate earning is expected to slow down because of higher costs in servicing their debt with the interest rate, and there's an upward pressure and increase in wage. In October 2018, the International Monetary Fund has adjusted their forecast to show a slowdown in global expansion in GDP and published a statement saying expansion has become less balanced and may have peaked in some major economies, and highlighted the downside risk of global growth. The combination of the disruption coming to the financial market and expected slowdown in global growth has created a perfect environment for increase in volatility due to the speculators coming in and out of the market. For example, in 2017, the S&P 500 had an 8 occurrence of price movement greater than 1%. And that number has increased in 2018 and expect to continue to grow in 2019 and beyond. This is a critical time for investors to stay calm and make a strategic investment decision to make sure they build a strong portfolio which can endure through this turbulence. After analyzing the market outlook published by institutional investors, I've identified one major gap from their analysis, which was the global debt. Since the crash of 2008, the central bank has lowered the interest rate to near zero for a prolonged period of time, which encouraged the behavior of spending instead of saving. As a result, the global debt has reached all-time high, over $180 trillion. The households was encouraged to open a loan with a low interest rate to purchase their automobile or house and other expensive purchases, And the company has become highly leveraged with cheap debt. And the government has increased their debt ceilings to trillions of dollars, which caused the central bank a limitation on their ability to orchestrate a soft landing when we head towards near the end of the business cycle. The purpose of this video was not to promote fear in the market. Instead, I want to make sure you're prepared. When the weatherman tells you that the storm is coming to your way, it's not to tell you to panic and sell all your belongings and your house. Instead, they want to make sure you're informed of the disaster that is coming. I want to highlight 3 things that you can do to prepare for the financial storm. First is to establish quality. Make sure you reevaluate your portfolio and then make strategic decisions to start accumulating quality financial assets, such as bonds with high rating or companies with a clean and healthy balance sheets. 2 is to build liquidity. Cash is a king during the financial downturn. That is why investors such as Warren Buffett has been accumulating cash over past couple of years to make sure that he can take advantage of the financial market downturn and invest in a quality company with low evaluation. And third and last is be productive. I truly believe that individual productivity and value can drive a sustainable economic growth. Make sure when you're at a company, be productive, drive value, and make meaningful impact. And make sure you're productive in your financial studies too, so that you can become an intelligent investor and make sure to achieve a financial success. I am both fearful and excited of what's coming because we're first time headed into the late business cycle with large population of baby boomers expected to retire. It is estimated from now to 2030, about 10,000 baby boomers are expected to retire every day, transferring over $24 trillion to the millennials. I hope you're excited to start gathering necessary equipment and ammunition to take on advantage of the financial opportunity. I hope you enjoyed this video and let us learn, analyze, and invest.